6 months now, executive director at the Alliance of Angels. We're one of the largest Pacific Northwest-based angel groups in the country, well, in the Pacific Northwest. Over 200 members strong. We specialize in life sciences, deep tech, hard tech, tech and life sciences, and CPG. We have members that are individuals, families, family offices, firms. We invest across the US and Canada now, and we also have a virtual membership as well, so we have members across the US now too. And with that, I'll go ahead and let our panelists introduce themselves and test out those mics. Mara?
All right, I'll try first.
So I'm Mara Nelson. I think it's just on.
I'm Mara Nelson. I've been with Alliance of Angels for, I think, 6 years now. Co-chair of the Life Science Screening Group along with Eric Larson, so I spend most of my time looking at life science groups. I've been angel investing for 11 years now. I started with Wings in Seattle, which was a med device focused angel investing group.
And just a random icebreaker question. If you could have one company exist or one product that you've either seen or you wish could exist, what is one idea that you wish existed that doesn't?
Besides transit over 520, there's so many of them. I think a treatment for cancer that works and is personalized for everyone.
Yeah. John?
I'm John Seacrest. I run the Seattle Angel Conference, which is under the umbrella of Mossy Ventures. We're an angel training program. So we're a chemistry lab class learned by doing blow up things ourselves instead of having people tell us about their mistakes. So we grow new angel investors. Several of the people here are alumni of our program. And the goal is to get more lead investors who are effective at helping startups be investable. And so I think that getting flow in the ecosystem and doubling and tripling the flow at the early stages depends on effective angels. So we grow those new angels. So we didn't do the test. I will do the test. How many people here are angel investors right now and have written at least a check? Okay, so I think there's 7 people. How many people here are founders who want to know how to get a check? So maybe 10. How many people are not yet investors but want to be investors? Okay, so you're my audience. So I take you and move you into the first group of people who have written a check. And so we're sort of the kindergarten of angel investing. We give you a chance to play in a pool, hold hands, sing Kumbaya, and make an investment, and then figure out what your investment thesis is, and then go to the group that's appropriate for you in your thesis. And if you can't find it, we have a fund manager peer learning group to help you create the group that's appropriate for your thesis, all of which has happened in Seattle. So, yeah.
And what about one thing that you wish existed? Sorry.
That's such a hard question. The short-term thing is I wish fusion worked now, and it would change the economy dramatically if fusion worked now. But I think that if we got real functional carbon nanotubes, our whole world would change rapidly. And so I wish the carbon nanotubes could be like, 50 meters long, and then everything would change.
Corinne?
All right. Hi, I'm Karen Kidder. I'm the executive director of E8 Angels. We are a nonprofit membership community of impact investors that are focused exclusively on climate and clean tech investments. We have about 130 investors. Our model is primarily online, although we were founded here in Seattle in 2006, so we have a lot of members here. So if you're out and about at a climate event, you'll probably run into somebody. We invest across the US and Canada only right now. Pre-seed to Series A stage. We do a lot of educational programming in addition to our normal investment cycles. And we have a philanthropic fund where you can invest your philanthropic dollars into climate companies. We also have an annual fund called Regenerate that invests along meetings where our members invested in the core model is direct investment for our members. I have done SAC a number of times. I've been executive director of E8 for a couple years, and I was an investor. I'm also an angel investor, so invested through E8 and a whole bunch of other angel groups around town. Not AOA though. I should have probably joined AOA at some point in my history, maybe in the future. So yeah, that's who I am. And the one, I wish you could give me that question in advance, then I could have prepared for that question. John had some good climate answers on that one. I do wish there was just some sort of silver bullet that would make sure our planet was a hospitable place for our future generations. I don't have what that unique solution is, because it's gonna take a lot of them, but you suggested a couple good ones. Fusion and carbon nanotubes, but I don't have a perfect answer for that.
That works.
Yeah.
Maybe it'll come to you.
Maybe it'll come to me like, oh, that's the thing.
Or tonight at midnight, you know.
That's probably when it'll come.
So, share with us, Karen, starting with you, how did you find out about angel investing? When did you start? Who introduced you, or how were you introduced to it?
Yeah, I was actually, during my MBA, I studied entrepreneurship and innovation, and so I was introduced to it through that. And then when I left my business program, I ended up working for an early stage company, and it was a female founder that was trying to raise capital, and I watched her struggle to do so, and I thought, gosh, I need to be on the other side of the table and create impact by deploying my capital into a sector where I can see opportunity. And so then I kind of did dabble a little bit, and then a friend here in Seattle said, hey, I'm going to this thing called Seattle Angel Conference, and dragged me along to John's program. And so I did that a number of times, and then joined a whole bunch of groups. So that's kind of how I got into it.
How long ago was that?
Gosh, so what year was that? So it's probably a couple years before that when I made my first angel investment, but like, it's been 7, 8 years ago-ish.
I'm curious, did you go there the first time alone, or did you find someone to go?
Yeah, I went with a couple folks that I knew, so, I mean, that's the thing is I feel like, when you go with others, it's much more fun because you've got this, people you can immediately connect with. We try and do that E8. If you don't know anybody, we try and connect you with others because it creates it's just a more dynamic journey into digging into companies and making investments and finding what really sings to you individually. But I had a couple friends that moved me in on that journey for sure.
Yeah, makes a lot of sense. And there are, I guess, two different angel investors. There's the solo investor and the ones that go into groups too.
Yeah.
John, when did you get introduced to angel investing? When did you start? And how?
So I was doing internet service provider inside Oregon State University, and got the business opportunity to not be in university to do it. So I raised money from people around there that ran me into the Software Association of Oregon, which then led me into the OEN group. And so I was rapidly provided with the opportunity to be an entrepreneur and learn that way. And then after that experience and after running that business for a while and selling it, I then ended up being the economic development director of Corellis, and the engine of how do I get startups to go faster? Well, need angels to fund the startups to get them out of the closet so they can get them to go. So we created the Willamette Angel Conference, copying the Ben Venture Conference and the Angel Oregon program of OEN. And then when I moved up here, I saw the same gleaming light at the bottom of the thing where everybody was moving up and nobody was writing early checks and nobody was sweeping in the new people very well. So I started the Angel Conference here in 2012 after some juggling of going other places and not finding the answer there.
How about you, Lauren? How did you get introduced? And
So I spent most of my career working technical. My degree is in electrical engineering. I did product development for medical devices and physio-control. I retired from there and wasn't quite ready to stop working. So I set up a consulting business with a plan of working with startup companies, mostly for setting up quality management systems and helping them through the regulatory aspects, because I needed a break from product development. One of the gentlemen I met at one of the networking events and said, oh, if you're looking for startup companies, you should come with me to this angel group in Seattle, because there's a lot of startup medical companies there. So I went to my first Wings meeting, expecting just to network and meet other companies. The first company I saw present was Cyrus Biotechnology, which looked absolutely fascinating, and then I got hooked. So I spent 6 years with Wings. I became aware there were actually other angel groups in the community, including AOA, but I didn't really feel comfortable branching out until looking at any other companies, because all I knew was medical devices. Wings was eventually a success in that they came into being to increase the amount of dollars going into medical devices and medtech in general in Seattle. And when they started, I think it was in 2008, none of the angel groups, Karatsu, SAC, AOA, were putting any money into medical devices or medtech. SAC didn't exist, but later they did. But they weren't putting money into these companies, and so Wings was founded as a partnership with Life Science Washington to help educate people about what you look at or look for in life science companies. That was amazingly successful, and when we did a survey of the angel groups in 2018, somewhere between a quarter to a third of their portfolios had shifted to medtech, med devices, healthcare, and things like that. So there just wasn't a space anymore for an organization that was focused only on medtech. And we declared success and closed Wings down then. I had met Eric through Wings, and he kept talking to me about AOA, and I decided if I was going to continue angel investing, I needed to learn more about other companies besides just medical device companies in order to be successful. So I came over and joined AOA in 2019 and have been active looking for med device deals, but it's been really helpful, again, to have that community to learn more about software and AI and all the different companies, consumer product goods and climate tech and everything else. If you're interested in angel investing, I would highly recommend finding yourself a group that you can talk to, that you can bounce ideas off. They learn from you, you learn from them, and you just have a much better experience and a much better chance of being successful.
Yeah, thank you for that. It's a good segue into you might have an expertise that, deep expertise that you come from, and that's very helpful to an angel group, but you might not understand the business aspect or the business model or revenue streams and cost structure and channel partners and all the other pieces that make a successful startup, and at different stages too. And so that's where it's a really good mix of expertise that you might not have, but you can add to and help with something called due diligence. But also, so it leads to the question of what makes a good angel investor, or what is an angel investor, and so we can talk about the legal structure of what actually technically is an angel investor, but also, how are we different from the other levels of investments too? So would anyone want to tackle what is an angel investor, and how are we different from other types of investment?
Let's do another survey.
Turn your way.
My tech staff here.
I wear mobile hats all the time.
How many people know what Reg D 506B is? Raise your hand. Okay. It's good bedtime reading. You should read it, and you should know what Reg D 501 is. So all of you that are founders, and you go and talk to somebody who is accredited, that's defined in Reg D 501. It's basically $1 million not counting your house, or 200K in income every year, 300K with your spouse. Or importantly, entities that have 5 million in assets, which means nonprofits, angel investors. If you meet that, then you're allowed to do investment that's unregistered. So angel investors are people that invest their own money and are wealthy enough to afford to invest their own money and not die because they invested the wrong money. That's the theory. Reg D 506B says you can invest in unregistered stocks if you're accredited and you don't generally solicit, which is you don't go to public meetings like this and say, I'm raising money. So as a founder, when you say, I am raising money from angels in a public room, you are probably violating the general solicitation rule. And so you would like to understand this as founders. As investors, those already doing that already know this. The ones that are not yet doing it, you need to fit the box, right? And if you don't fit the box, you need to work on doing that. Now, I have a plan for using philanthropic dollars to do angel investing, and we'll talk about that at another meeting on Thursday. Angel investors invest their own money. Venture invests other people's money and takes a fee. That causes fundamental distortions in how they engage with the companies. So my rule in my program is if you are investing in a company and you have no value besides money to give to that company, then this is the wrong investment for you. And that's the magic of angel investing, is that I can be paying attention, caring, introducing, herding, otherwise helping the startup and making the startup more effective, which then makes me more money in the end, and my incentives are aligned to make that a great company. As opposed to my incentive is to find a company that will be very, very, very big, and it will cover the rest of the portfolio, which I will then not pay attention to because I'm aiming at a very, very, very big deal. Those are way different incentive structures.
Can I add a non-technical answer to that question? So I mean, I think one of the reasons I got into angel investing is because I wanted to learn, because there's access to networks. And so kind of to Marvin's point about when I joined E8, I joined because I knew a lot about water. And I wanted to learn about built environment and ag tech and all these other sectors. And I've done that through the group. But that was as an angel investor, I'm the one in control of how I deploy my capital. I'm the one that's going to be focusing my energy in an area that I'm most interested in. I also am an investor in funds, so that is a great way to get exposure to this kind of early stage asset class, as I call it. These early stage innovations. Funds are a great model for that, but you're putting your money into something where they're making decisions because you trust that they know what they're doing, and that's why they take fees. So but that's kind of the distinction I see personally in terms. But I built my portfolio around both of those things. So you don't have to do one or the other, you can do both, or you just figure out where you want to put your energy. So
Value add, are you a value add investor, or
Yes.
are you a check and get out of the way?
yeah, exactly, right.
And I would definitely encourage you to diversify how you invest, and the way I treat my angel money is it's money I can afford to lose. Because most companies will go out of business, or will not make it, or will not exit. So if you are a founder, listen carefully, because the name angel investor is misleading. We are not being beneficial to you or being philanthropic. Angel investors are investing in companies to make money. The only way you make money as an angel investor is when your company exits. So if you want to grow your family business and make it $1 billion business, but it's always going to be private, you will probably not get angels invested in being involved in that, because there's no way they're getting out their money. So when you're coming as a founder, think about what your exit strategy is, or at least think about how the people that are investing money in your company are going to get their money back out.
So to jump on the tail of that, the deal terms in your investment constrain what kinds of investor you can have. And so if you have a family business that you want to remain private, you cannot take money where you're selling equity and expecting the sale of the company to return the process, because that destroys the goal of having a private company. You can use revenue redemption models to do it. So there are different terms that you can do, which will never be interesting to a venture group, but would be very interesting to a class of angel investors. So if you are an angel investor that wants to spend your own money on local investment in local community and build local stuff, You cannot likely use equity and exit as a mechanism to do that. But you can use equity and a redemption out of revenue to do that. And there are ways to do that. There's a book by Looney that's revenue-based finance that talks about that. So if you are a founder who loves your business and you want to keep your business and you want to take money, but you want to grow your business and keep it, you're not going to get venture money. And don't expect to get venture money. Then you have to find the right investor for you.
Those revenue-based financing options, it seems like it's harder to find when you're, you pitch angel investors and hope that you might find that one that does revenue-based financing. It's like, well, you already have to go out and find the needle in the haystack angel investor that fits you anyway. Now you have to go and find a revenue-based financing investor. Any tips on how to find those?
Yeah, well, my belief is that we can run a local angel investor conference and find that group of people and practice that together. So I'm starting to look at the question of doing essentially verticals. So I'd like to do a climate angel conference. I'd like to do a local angel conference and focus in on that question. It affects not only the companies that can come in, but it affects the investors that can come in on both sides of the equation. But if you go to Seattle Good Business Network, there are a lot of philanthropists that are running around that trying to help local businesses, and they just need to be educated on revenue redemption as a mechanism, because they have the money, because they're being philanthropic.
Right.
And there's some groups too that focus on that. Doesn't Lean Creek do a revenue?
She has a revenue royalty model,
Yeah.
but it's not a revenue redemption model. But yes, she's got that out of Boise, Idaho. Looney Creek has a program, and that's not the Sage Fund.
It's a Sage, I knew it wasn't Lean Creek, I got it, it's a the Sage Growth Fund, I think is what it is, and they have
But they're definitely up in the age of the company. They're not taking startups so much as they're taking companies that
have some revenue already.
have flow and predictability.
So as both a founder and an investor, all of these different ways of financing mean that when you're looking at investing in a company, you're not just looking at this round. You want to look at what's their funding plan long-term. Are they getting non-dilutive revenue, which will help keep the costs down? Are they going after family offices? Because all of that is determining whether the business success is going to happen. So as a founder, you want to be laying out your financing plan. As an investor, you want to understand what the company's financing plan would be. And as a founder and an investor, realize that all of those have different customer needs. When you're a founder, you often look at the customer needs of your product and how you're going to do the software and all of that. Every single person that you want to approach for funding is a customer. And the pitch deck and the information that you put together for the philanthropic group is very different than the one you're going to put together for going to AOA. Is very different from the one that you're going to put at a venture capital. So spend some time understanding who your founders are and what's important to them, so when you pitch, you can connect effectively.
Thank you, that's great, that's really great.
There's also a group called the Impact Finance Center that has a goal of getting philanthropic people to diversify their investment portfolio to include impact and investment together. So they have many programs that are worthwhile for people that have that kind of question.
So for everyone here, there are changes in the way you can get financing. And there's also changes happening right now about certain types of financing. What's being, seen, we all know the YC SAFE model, right? There are other kinds of opportunities there for us as well. There's convertible notes and there's equity. Do we want to touch upon real quick, what is a SAFE versus a convertible note versus equity? And for the founders here looking for investment, here is a thought process of why we look at certain types of investment vehicles a certain way. We're not all against SAFEs, but there are some things that we think about as investors. So could could we touch upon, someone explain what a SAFE is? And then we'll move on from how that differs from a convertible note in equity.
Before we talk about the details, again, coming back to this idea of your customers, what you want to have is an investment vehicle that shares the reward and shares the risk. So when we talk about equity and all of this, what we're really talking about is differences in how you share the reward and the risk.
And it makes sense for your company, like it really makes sense for where you're trying to go, that you're using the SAFE versus another.
SAFE, technically defined, is simple agreement for future equity. So it's a simple agreement, it's guaranteed, that when you reach a certain stage, you're going to be getting equity in the future, right? So that's it's just a simple agreement for future equity.
It's a contract.
It's a contract, yeah, exactly. So that's, I will tell you though, from a more general standpoint, in terms of what we see, we do not lead rounds at E8, so we are reliant on companies coming in, having some sort of an investment vehicle for us to invest in, and we see convertible notes, which is debt ultimately, and safes, we see all sorts of things. And some investors avoid some, there's some that have been like very controversial, safes for a controversial period of time, and they've modified the SAFE agreement slightly to make it more founder friendly, because it used to be more investor friendly. So it's a constantly evolving thing, and I don't know if you've experienced that too, I'm sure you have, but you know, we will invest in most of those vehicles, but there are subtle nuances you want to consider when you're looking at them. We actually did a session with K&L Gates on just this, so I know we have one online that you can find that talks through these in great detail, all the different options. I'm sure AOA has also done an event like that as well.
Yeah, the AOA website, if you go to it, there's videos for various events or for various webinars we've recorded, including the differences. Basically, if I'm being a bit snide, I refer to a SAFE as a zero interest loan. Because they're basically, you get money, there's no end date, there's no interest accruing on it. Your money can sit there for 5 years, 10 years, 15. It's a very simple agreement. As Karen mentioned, they've made a lot of improvements in it, so there are now sunset clauses. There's now an agreement that it will automatically convert to equity. You can add some of these clauses. The more clauses you add, the more it looks like a convertible note, which is essentially a loan agreement. I give you X amount of money, you pay me a certain amount of interest, it ends after 2 years, and when I was first investing, the notes would have a clause where you could either pull your cash out, or you could convert it over. Pretty much all the notes I see now are you convert automatically to stock when we go to an equity event. Equity is private stock. Very similar to buying stock on the stock market, except it's unregulated, right? So,
To quicken it, it's a simple one-for-one sort of thing, money for
stock.
Frame that a little bit tighter. We have loans of kinds. We have loans that convert into equity, which is a convertible note. We have safes, which are contracts for equity, which everybody's trying to pretend really hard is equity. And then there's common stock, which is what the founders are getting. And then there's preferred stock, which the venture capitalists want. And so there's a range of choices. The important thing for the founders is you get to choose which of those you're doing, because you're the one that starts the fundraising round. So you need to be clear about what that is and what the consequences are. One of the great things about angel investing as an asset class is that there is this thing called QSBS, Rule 1202, qualified small business stock, which if you hold it for 5 years in a small company, less than 5 or 50 million in assets, when you invest, then you get to keep the first 10 million of your investment tax-free, 0% tax for the first 10 million. Now, there was a recent change, and that's moved from 50 to 75 million, and it's moved from 10 million to 15 million, and they've added a couple of, if it's 3 years, you get to keep 50% of it. If it's 4 years, you get to keep 75%. Lots of little edges to that. But the fundamental idea is for most angel investors, you write a check and they hold it for forever, and then when it finally exits, you get to keep it with no taxes, which is very few other mechanisms produce cash tax free. So that depends on you investing in stock. People argue very strongly that debt is not stock, and therefore convertible notes is not stock. There are people that whine about safes not being stock, but we're not sure because nobody's tested it in court. So there's some notion that you should do a price round. Why don't we do a price round? Because it's too expensive to do a price round, people say. So finding ways to do price rounds that are cheap, easy, and fast would be very helpful for the angel investors if they could get there. So that's one of the edges of angel investing. We don't do that properly. We spend $20,000, $30,000 to do a price round. When we're investing $100,000, it makes no sense, right? But you, the founder, probably don't know all the details of all of what I just said, which is why you need to have a lead investor. So when she says we don't lead rounds, one of the roles of the lead investor is to help you craft a round in a set of prices that they think can get funded. And their job is to negotiate the deal with you and then help you fill the round so that it goes through. So finding a lead investor early before you formulate your round is probably worth a lot.
And one last question, and we'll open it up for questions. What stage or stages do you prefer to invest in, and maybe give an example of like what a perfect deal would look like on the surface? Maybe deal terms, industry, founder backing, etc.
Okay, I'll start. The perfect deal, oh my gosh, the perfect
And what stages do you invest in?
stage. We invest pre-seed to Series A. I would say the majority of our investments are at the seed stage. So our investors are really looking for a little bit of traction so that there's some real market customer validation and market fit is validated. So definitely love to see a little bit of traction, but that early phase, early-ish seed kind of stage is ideal from, I think, my perspective as well as our investors. We love to see deals, and again, since we don't lead, we typically have them coming with somebody who's already funding them, and that just gives another good indicator. I was chatting with somebody earlier about that. I can't remember what we were talking about, like the collaboration between folks. If AOA comes to us with something they've invested in, then I'm excited to take a look at it, and so that validation from other groups or VCs is always a bonus. So an ideal deal has a little bit of traction, is at the seed stage, and has another investor on board in an ideal world,
So when I started angel investing, I was looking at the technology and I was looking at where they at and how far they going and all of that. I start now, again, my goal as an angel is to make money. So I'm looking at the company valuation. And if the company valuation right now and the potential exit that I can see coming isn't a substantial multiple, then I probably won't take a look at it. So the one thing I would add to Karen's is the valuation. Because I have seen companies that are in that very same stage. They're pre-seed, it's promising, and their valuation is somewhere around 50 to 100 million. And their exit price is around 350 million. And I'm going, that's up 3.5 times. If you listen to David Rose, and if you are getting into angel investing, I would highly recommend you go listen to David Rose's stuff from New York Angels. It's really good. But if you have a portfolio of 10 companies, this is how he summarizes it. If you have a portfolio of 10 companies, 6 of those will go out of business. 3 of those will basically break even. So if you want to come out positive, you need a company least 10x. So out of those companies, you want at least 10x. So if you are angel investing, not revenue investing or things like that, you don't look at companies that are gonna give you 2 or 3 times return, right? You're looking at companies where you're gonna be swinging for the fences. So understanding and keeping that initial valuation low is really important, because the other thing that happens is they do additional funding rounds, your share of the company gets diluted. So if you go in at a company and the valuation is 10 million and they take no more money and they sell for 100 million, you make 10 times. If they've taken 10 million and then they take another 40 million, you aren't making the 10 times. So, you know, we invest from C to Series A. Typically, we're looking at valuations of around 5 to 20, maybe 25 million. The valuations get a little higher if we're doing follow-on deals. We have several companies now where we're fortunate where we invested the first round at a very low valuation. The companies are doing well, we know the companies now, we know they've got traction, so now we're comfortable investing at a higher valuation. But it's very tricky when you're investing at the pre-seed and the seed round, because these companies are not making revenue. This is not like looking at the multiples and where are they sitting and all that. These are companies that don't have any revenue yet. And so estimating the valuation for it is more of an art than a science.
And you can't do that by yourself.
No.
So for my program, my goal is to teach angels and give them perspective. So I don't have a sector thesis, I'm not clean tech, I'm not looking for technology and stuff, other things. I don't care what kind of company it is, because I want perspective. I want them to be raising around between 250 to $1 million-ish in their round size, because then our 200,000 that we're going to put in will be important and interesting and useful. That's the only criteria. However, what makes an investable company is important. So I am frustrated as a lean startup fanatic that companies without revenue are getting funded. Because I think that the only way that you get the customer problem fit is that you get people to pay you in step 1 that says, oh my God, I have this problem, please tell me how to fix it. And then you can build up product revenue at step 3.5, where now you've got a following of 10,000 people that are all excited about you, and you're finally getting close to a prototype that would qualify as an MVP. So I think you should have revenue all the way through. So if you as a founder cannot get customers to pay you for information about the problem, you do not have enough customer problem fit, and you do not have enough founder market fit. So I would very much like it if companies would like read the book and do what the book says that we got out of 2003 that says do customers first and get that to go. What we care about is when the money goes in, it's not spent on operations of keeping you alive long enough that you discover something, but it's designed to create a change in valuation. So I put the 200,000 in, your $3 million company now becomes a $6 million company. Hallelujah. I put the 200,000 in, your $3 million company ends up being a $3 million company that lived another 18 months. Don't like that answer. So figure out how the money going in changes the productivity and value of the company. I, as the angel, need to see that. You, as the founder, need to see that and make that go. As the company is growing, it's maturing a whole bunch of things. So what market you have, what subsegment you're engaged with, the structure of the product, all of that's going to evolve in most cases from when you're pre-seed all the way to your Series A, right? But what that evolution looks like is very different from med tech to ag tech to whatever. And so you as an investor need to be clear on what you're going to look at. And that's why it's important to work in groups so you get multiple perspective on the process of getting into that thing. So my focus is how to take people who are less than 5 million in net worth to build a reasonable, rational portfolio. Now, she said portfolio 10. That gives you a 50% chance you're gonna have an outsized return. If you want a 95% chance of having an outsized return, then you need 20 companies. So I keep saying, build a portfolio of at least 20 that you invest as a group into things where you diversify evenly across those 20 things. And don't try to pick the winner, because in fact, our probability of picking a winner is very, very, very low.
So I didn't mean to say portfolio, if I did, I said if you take a set of 10 companies, the portfolio needs to be broader than that. That is one of the areas where, if you look at investing in 10 companies on your own, typical minimum investments are 10 to 25K. That's a lot of money to lay out, particularly if you're just starting in this. That's where it's very helpful to be able to go into a fund. I see Ken back there, so Packwood is one. The Alliance of Angels, we have a member-driven fund that has been very popular. E8 is, yeah. So you can look at, instead of making individual investments, looking for what your thesis is and finding a fund that helps you invest and get more leverage without putting out so much cash on your own.
Yeah, I think that fund is an interesting point. I know we probably need to shift to Q&A. Jane's like eyeing us, but fund's an interesting idea because, there's ones like Pack Ventures and Can, which are fabulous. But the member-driven ones, you get to participate, you get to use your voice, you get to vote on the investments as well. That E8 is called Regenerate,
Innovation Fund.
Innovation Fund.
Yeah.
So you have this opportunity to, put a 25K check in at the beginning, and then, be able to vote on what investments that fund makes. So you're driving some decision making in that process, which is kind of a great hybrid model too. So
And participating in the due diligence, which is a great opportunity for learning, because then you hear everything, or hear other people's opinions.
Yeah, absolutely. Well, thank you. Thank you very much. And thank you to K&L Gates too for hosting us. Can we give our panelists a round of applause? A couple of minutes. If we would like to, we can open it up for questions. And if we do have questions, I'd love to start with someone who wants to become an angel investor.
Oh. Hi, my name is Subhadeep. I'm with Google, and I'm interested in becoming an angel investor. I was wondering, the tax shelters that you're talking about, does that also apply to funds, or is that if you have?
Yeah, it applies to any stocks that you're buying, even if you're investing in funds, yes.
And to set that up, is it fairly easy? Is there like?
You just have to keep the record so that when you file your tax on the capital gains, that you've got the records straight.
Is there a tax person that you recommend?
yeah, and work to know, consult your tax person, right?
Yes, and finding a CPA that knows what QSPS is small group of people. So I suggest that you go to like AOA's events and go find the CPAs that are in the corner.
More questions?
Thank you so much for sharing, let's say, your consensus on what makes a good investment, as well as the differences in your individual investment theses. I have a question about the number of successful investments, or the success ratio. You almost make it sound like statistics. 6 will make it, 4 will. Let's say I made an investment, nothing big, maybe 10 to 25K, in a company based on a good team and a pitch deck that has burned through my money and other people's money. Now we see teams still engaged. We see some positive reviews for their product, but lagging in revenue. I see the gesture.
No, the answer
That is clear. That is my question. What do you do in that case? Answer. That's very clear.
You go and advocate to the next round of people up that are writing the check over there about why you think that they should do due diligence on the company. you should keep your hands in your pocket, and you should not write any more checks. Because that's a loser, right? Putting angel investors in the pre-seed and seed stage lose money when they follow on. So that's measured data. So if it's not doing well, your goal is to get a Series A group to decide that it's a good bet. If they can't decide that, you should just keep your hands in your pocket. Now, what's important is that you got 19 others of those that you've done. And if you were just a millionaire and you took 10% of your net worth, you just spent 25% of your whole thing on that $25,000 investment, because you get 4 investments out of 100,000 at that rate. So you should be writing $5K check or a $2,000 check into the thing. And the only way to do that effectively is to do it in groups with some kind of special purpose vehicle to hold the money together, right? And so my belief is people below 5 million in net worth should all be writing small checks in groups. And if you're not doing that, I mean, the small check would be $25,000 into their fund that's going into 8 companies. That's a good answer, right? $25,000 into one company, not a great answer unless you're above 5 million in net worth.
So of your whole portfolio, what percentage is this early stage investment you recommend?
Less than 10%, 10% or less. Mine is a little bit more than 10% at this point.
I've heard others say 5, 4.
Yeah, I think I'm at 5.
Yeah, 10 is big.
Basically, it's, go back to the, if you can afford to lose that money and it's just gonna go away, I take my angel investments, they're not included in any of my financial planning or anything like that. I just
Yep.
assume it's gone.
The other thing I'll quickly throw out there too is maybe introduce them to some customers. You know, I mean, that's the beauty of, I think, becoming an angel investor is it's not just about money all the time. It can also be about introductions to somebody that might be a customer or trying to, you know, help them beat down some doors to get that revenue stream.
But my advice is go slow, right? If you're gonna get into this or you wanna do it, write a couple trial checks, like what's gonna happen to this company? Don't necessarily go out and say, oh, I need a portfolio of 20 companies and invest in 20 companies. Due diligence often takes weeks, even for an angel group when we're looking into it. So don't invest on the basis of a 15-minute pitch unless you know the founder and you've got, there's other reasons behind it.
Hi there, thank you very much. I'm Janelle, and I'm actually from the Bay Area, so I kind of have 2 questions. One, do you advise people to participate in an angel fund in their own area? And secondly, on average, what would you say that turnaround time is if you're investing in 20 companies? When do you start seeing those companies hit the exit?
I'll speak to the investor in your own area. I mean, I think we have a number of good-time members in San Francisco, so we've got a big group of folks down there. So it depends on what you're looking for. If you're looking for a fund that invests regionally, or if you're looking for a fund that invests all over, or if you're looking for people you can chat with in your direct region, you know, it depends on what you're looking for. So, but we do have, E8 has a number of members down in San Francisco, and a number of members of our fund are based down there too. What was the second part of the question?
What's the timeframe for an exit? So Seattle Angel Conference is virtual. We haven't recovered from COVID yet. The consequence of that is that we've created a transatlantic angel conference too. So we're in 4 a year. So if you care about investing in Europe, we have a program which is full of European investors. And so the real question is, what's your thesis? Do you care about climate tech and what's happening? Now, I really want them to invest in Europe, and I keep poking.
We'll get there.
But what's the thesis? What's important to you? Is it women investors? Is it climate? Is it local? Is it biotech? Is it pharma? Just what's the important thing that you want to put your brain against to try and make that go and try to make the program go? Lots and lots of, since COVID, lots and lots of angel groups have opened up widely, and there's, I understand that there are a bunch of people on the East Coast that have now joined the West Coast angel groups, and they fly every quarter or so over to the in-person meetings, but at the Programs are now on video and they watch video streams of the things. So you can get a lot of hybrid stuff going right now. And then it goes back to your thesis, what's important to you. And that's what my program's about, is figure out your thesis and make that go. And my answer to duration of an investment is, I just got a good exit from my Oregon Angel Fund 2008 investment last year. So that's 16 years. And so good investments take longer. And therefore, I would expect that in early pre-seed stage, that you're talking in the 12 to 15, 16-year range.
Yeah, and that's consistent with the information. Angel Capital Association is a nationwide group that is kind of an umbrella organization for a lot of angel groups. They have a great website with a lot of information, and I would encourage you to go to that one. But they're looking at, I think, 12, 13, 14 years for exits these days. It was shorter previously, economic situation being what it is, there just haven't been as many exits lately.
A lot of things that they used to quote were VC numbers. So if you're coming out of VC at Series A and they're talking 5 to 7 years, then add another couple years for seed, add another couple years for pre-seed, and you're now more in where the average is turning out, right? 10 to 12 to 15 years.
And I would definitely follow your interests, but there's a term called syndication, which is when our group goes to Karen's group and says, hey, we really like this company. So if you join an angel group and it's, up here or wherever, down in the Bay Area, there's a lot of groups, and you can contact them, and they'll often have events, or you can meet people from the groups, so you can still form a community down there, even if you're not part of a specific angel group in your local area.
And there are syndication networks, both from Keiretsu and ACA, that are involving hundreds of other angel groups. And so you can find deal flow through those syndication networks.
Yeah. Tech Coast Angels is also a big syndication hub.
We'll take one more question and then we'll wrap up.
Hello, I'm Pradesh. I'm actually here as an investor. And thank you very much. I think all this was really helpful. My question is, what's your observation of this year as compared to last year? Are there more investors out there? Are there more startups? I'm just reading these news of new funds getting created. So it would be helpful to know about that.
I'm happy to start. What I have been excited to see is that our member interest is as high as it's ever been. So I think there are a lot of private investors that see this as an opportunistic time to get involved in angel investing. Also potentially since we invest in clean tech, we're seeing a lot of pullback from the federal side in terms of investment in this particular area. And so a lot of private investors stepping forward they can't fill the gap, but they can try and help fill the gap a little bit. From the company side, a lot of companies are shifting, pivoting subtly, trying to figure out how to expand their runways, trying to figure out how to be very strategic about when they're raising, how much they're raising. So there's definitely been a change in terms of it's not business as normal, it's the new normal, and it'll evolve, and 5 years down the road there'll be a different normal too. So it's shifted, and I think from an investment number standpoint, we had hoped we would be investing as much as our members would be investing as much as last year, but I feel like people are being a little reserved, they're being a little cautious, there's some economic uncertainty, as all of you know, and so we'll see what the end of the year holds, but it's slightly different, but there's still a lot of people interested in working in this area. That's been my experience from EA's perspective.
So the last 2 rounds of Seattle Angel Conference have sold out. There's only 40 slots, and we sold all 40, and in fact didn't close it fast enough, so we actually the last one had 43 in. And so I don't know what this round is going to look like. There's a little bit of extra noise since January that we'll see. But the thing that drives it is the stock market price and people's perceived wealth as a function of their stock market price. And since the stock market hasn't dropped 50% like it has done 2008 kinds of things, people are still writing checks and moving forward. And I agree, my experience is that people see this as an opportunity. There's an expectation that the 9,000 people that got let go of Microsoft are gonna do startups, and that there's gonna be interesting startups happening at a pace, and they're leaning into where's the good ones.
So it's a supply and demand business, right? It's the supply of private money versus what's the demand that the companies want. For the past couple of years, there's been a lot more demand from startup companies. There's a lot of them out there. And so it's been, I think, harder for companies to find funding. I know that a lot of our portfolio companies have experienced that. It seems like it's easing up a little bit this year, although, it's kind of hard to tell because it depends on the industry. On the life science side, we also have the cutbacks on the granting side. And what we've seen, if I compare, going back to valuations, if I compare valuations from like 5 years ago, we were seeing $15, $20 million for companies that were pre-revenue. Similar companies now, their valuations are down to 10. So from an investor standpoint, again, it's hard to pick the right companies, but the valuations seem to be a little bit lower this year for companies that are at the same stage, or for companies that were at a similar stage. That may bode well for the future. But I think there's also more visibility into public markets. So 10 years ago, nobody knew what angel investing was, and it was just for the very special people. And now I get blasted by emails all the time talking about this in the private market and that in the private market. So there's a lot more visibility for people. And I think there is somewhat of a perception that the wealth is starting to get realized more in the private market. And by the time companies IPO, then, a lot of that value's already been realized. So there's kind of a push on I want to get into that market side, as John said.
So the number of accredited people by law was hovering about 10% for the decade, right? For the last 2 decades, except for the last 3 years. And we did this great big jump since COVID from 10% to 15%. So there's a full 30% of the people that are accredited, that are newly accredited for whatever reason. I think it's quantitative easing. All the money went into a corner. But nonetheless, they are currently ignorant that they are qualified, and there's opportunities galore to find people who are not angel investing, to get them to be angel investing. So for founders, it would be worth your while to find those 30% who are unaware and make them aware, and try to get them into some programs and get them into being available to the early stage companies. So the money is there, it's just ignorant. It doesn't know that it can be deployed. It needs to know that it can be deployed, and then there's several ways that they can learn how to deploy it well. And so I would try to wake that up in some way. And lots and lots of money sitting on the sidelines because they don't know they can deploy it, and they're at extraordinary risk because of the volatility of the market and the possibility that that cash is going to go away for stupid political reasons. And so you would like to diversify out of the stock market into things that are not aligned with the stock market. Angel investing is one of those things. So this is a good time to be an angel investor. This is one of the post-2008 opportunities.
Well, I think we should end on that note. Thank you for the Q&A section and the panel. And we'll go into some networking, and there's food and snacks and drinks in the back.